To the Full Tracy Money Audio Commentary. This is Owen Tracy recording, and it is at 1:11 p.m. that is Central Time, and today is January 26th. Well, I have been through travel chaos, but I still plan to hit Melbourne on Wednesday morning, and I fully anticipate sleeping the whole way there. Usually what I try to do is do a bit of work on the plane, so I kind of stay ahead of the writing schedule. I don't know if that's going to be possible on this occasion, but I am certainly looking forward to the warm weather, the beautiful coffee, and restaurants of Melbourne, as well as hitting a couple of the matches at the Australian Open, as well as enjoying the company of subscribers at the chart seminar. Well, uh, that is certainly something to look forward to, and I try to maintain a sunny outlook. But the travel chaos that you have in Dallas right now is epic in proportions. And now that I think translates over into the business development company sector. Something that I think is rather interesting is that some of these business development companies have been trending downwards for a while. So BlackRock, TCP Capital, that gaps lower today. And I think that's an extension of the downtrend, and the downtrend has been underway for nearly 2 years. Now, what do they do? Well, one of the things they do is they aggregate some of the more successful Amazon businesses. And the logic is that you try to aggregate. You look at all the successful businesses, you go off and you buy them, and you try to introduce economies of scale and make, I guess, the sum of the parts being worth in the individual members. That's the whole business model. But markets change, and competition on Amazon is intense. So it's not altogether sure that the success from one year to the next is going to persist. And that's certainly starting to weigh on some of these companies. So that certainly seems to be one of the factors that really hit into a lot of these companies. And it's very similar, I guess, when we look at Blue Owl. Now, that had been very vocal in how much they were investing in data centers. And then the share dipped very significantly at the beginning of last year, and it's still trending downwards. What I find particularly interesting is that I was listening to the Odd Lots podcast yesterday, where Michael Zeditsky, who is the head of Blackstone's private credit, and he was talking in effusive terms about how wonderful the sector is, how successful they have been in building out the business, and talking about how customizable these loans are, how it cuts out the intermediary, that it's almost like the Amazon effect for the sector. And I think these are sort of important questions that we've had prolific growth. I think that's certainly one of the most significant factors. There was an additional point today that Apollo, they have lost about 170 billion on one of their investments. Now, I think it's rather interesting that Blue Owl also peaked around the same time as Apollo, had many of the same kinds of investments. And then, of course, Blue Owl had to pull out of its investment in our co-investment in the Starlink data center with Oracle. But other than that, Apollo has quite a similar chart pattern overall. So this is raising sort of important questions about the wisdom of investing or co-investing in data center construction. And then we can think about the fact that you've got companies like Meta and Google. They are very active in issuing investment grade debt. And now the volume of debt in the investment grade sector is growing within the technology sector and approaching the size of the banking sector. And that also, of course, pushes some of the risk in the sector onto the bondholders. So one of the things that happens when you issue more credit, or you issue more equity, is you're diversifying the risk from the company. And that's certainly something that seems to be underway. And I think we also can look at how this is playing out with Taiwan Semiconductor, because there's a clear shortage of AI chips. Or I think perhaps rather than saying there's a shortage, it's simply that demand is currently outstripping supply. Now that's certainly beneficial for Taiwan Semiconductor because they are not spending the capital necessary to radically increase the supply of those chips. So prices for those chips are rising. They have control of supply, and they are not spending that cash down to build the excess manufacturing capacity, and that's helping to support the share price. And it's not really looking like there's going to be a big swell of investment from potentially competing companies. They don't have the willingness or the financial wherewithal to do so. But one thing also is that Samsung is benefiting in its own right from its own supply inelasticity trend, where it controls the vast majority of supply of memory chips, and there's a lot of demand for those as well. So what we have within the data center build out is a lot of demand, a lot of bottlenecks, and then you have the companies that had been among the biggest funders of those data centers starting to run into trouble. And that's certainly true within the business development company sector. So there's a lot of moving parts in here. And then, of course, over the weekend, we had everything that's going on in China. And I think I've written quite a bit about that in today's commentary, or at least as I was saying, I try to stay ahead of my writing schedule when I'm traveling. So I wrote most of it last night. But we have very little action in the stock market in China today. But where we did have quite a bit of activity was in gold and silver. So gold prices popped on the upside. And this is really a spectacular advance, but we're in the region of 5,000, and that's really quite an overextension relative to the 50-day moving average. It's not that dissimilar to the size of the moves we've had following previous breakouts. It's in the region of a big psychological level. So I remain of the view that some consolidation in this area is likely, but there's no real evidence to suggest that this isn't still a rather consistent trend. Now, of course, when we look at silver, then this is just an incredible advance where it is going up much faster than gold. And the price today got up to almost 120, and that is an awfully big candle, or tail on the candle. I think that it probably represents a peak of near-term significance. I suspect at least that we are going to see some consolidation in the 100 level. I've been saying for the last week or two that this is not the time for new money in silver, simply because the pace of the advance is profound. And when it turns around, then it's likely to be exceptionally volatile. And something that I think investors pay less attention to is when volatility is going in your way, then it just feels scary but wonderful. When volatility goes against you, it is a gut-wrenching fear that takes over. And the price today is at 109, and the 50-day moving average is at 80, and the 200-day moving average is at 50. So silver could fall by 50%, and it still wouldn't be unwinding the overbought condition relative to the 200-day moving average. So yes, we have a lot of demand. We have a great deal of speculation about the enormous shortage of physical supply. But at the same time, just because you're buying physical doesn't mean that you can sell your physical. And you may not get what you think it's worth either. And that's one of the challenges of you can hold silver, you can buy silver, but then the spread between the purchase price and the sale price tends to be rather large. And this has just been a profound acceleration. So I think it is important to look at the log scale chart, even though this is a futures contract, and the size of the advance has been totally independent of the margin requirements, and a lot of that has been because of a clear physical demand. But even on a log scale chart, this is an acceleration. And I don't think it's at all beyond the bounds of possibility that we could have quite a significant consolidation. But there's no real sign of it just yet. One day off the peak after an almost $10 advance, up nearly 10% on the day, that's not nearly enough to suggest that this is a blow-off peak. If we were to see a downward dynamic, that would be something that I think would be important to emphasize, would be a peak of near-term significance. And we did have a kind of a stab on the downside in December, and it didn't hold. Then we have the silver miners got up to 120 in here today, and that's a double since the low in November, or it's up and another that's almost 50% up since the peak in October. So these are really extraordinary moves. And when you have these moves, then you make a lot of money in a short period of time. But the reality is that you're in a situation where you're making money faster than you've probably ever made it before. And usually that's a sign that the market is getting really hot. And one of the things that happens in precious metals is you tend to make all of your money in short bursts. So that's basically what's happening in precious metals right now. And long may it continue, but it's also a time to be particularly vigilant. And I'm very conscious of the fact that in the event that my flight actually takes off, I'm going to be out off the markets for about 17 hours. And you never know what's going to happen whenever you take your eye off the market. Now, when we think about the oil market, well, we know that the USA is gathering a carrier group in the Persian Gulf. So that's certainly helping oil to hold in the region of the 200-day moving average, but not going up in an especially dynamic manner. The commodity that has experienced the greatest impact from the inclement weather in the USA is natural gas. And that was up in an exceptionally dynamic manner again in here today. Now, by the time we get to the end of next week, then weather will have normalized again. But and we're probably getting the worst of the bad weather in the East Coast today. And that's primarily the reasons why natural gas didn't peak on Friday. But it's very unlikely that these high levels are going to be sustained. And when we get out the other end of this storm, then there's a good chance that these prices are going to come straight back down again. And I think then when we look at the stock market, well, I think something that a lot of people are talking about is the possibility that a rally in the yen would represent a massive repatriation of Japanese savings from abroad. Well, and then that would have a negative impact on carry trades. But the Nasdaq was in positive territory today. The dollar was weak, but the yen was strong, and it gapped up through the 50-day moving average that looks like support in this area around 160 and weakness for the US dollar. Now, there's the possibility that with these dynamic moves that we could go back down and test the region of the 1,000-day moving average. And that might weigh on the Nikkei, but the Nikkei wasn't down all that much in here today. Something that I think is worth considering, that all that money that's been going abroad or from Japan and foreign direct investments, that was persistent for an awfully long time. And it happened during a period when the yen was strengthening. Now, we might argue that what investors were looking for was capital appreciation overseas. That might be true, or that they might even have been looking for an interest rate pickup. But at the same time, the yen strengthened really significantly between 1998 and 2011. And it's weakened even more than that since then. And that also didn't really affect the decisions about Japanese investors moving money abroad. They were doing it before the strengthening, and they were doing it during the weakening. So if they were to repatriate those trillions, where would they put it? Where are the markets in Japan that are large enough to absorb that kind of flow? Well, you might have real estate, but with demographics, why would you invest in real estate? You might have the domestic bond market, but why would you invest in bonds when you're only getting 2%? But then perhaps you might invest in infrastructure development, in rearmament, and that's a trend that you have in Europe as well. It's just not big enough to absorb the trillions. So I think that there's a strong likelihood that that money is just not going to come back, and that the flows we see coming back into Japan will be relatively modest. And that also suggests that the yen might not strengthen all the way back to 80, but simply that we'll go into more of a rangy phase. There was a good long time between 2015 and 2021 when the yen appreciated without actually breaking down. So I think there's at least a fighting chance that that might also be what we see with the yen on this occasion, and some stronger action for the yen that would certainly feed through into weakness for the dollar. And exiting US assets, that's at least, I think, a hedge right now rather than a floodgate. The kinds of things that would really create a floodgate out of the dollar would be if the tech sector were to roll over. But certainly there's issues with the business development companies and the size of private credit. And I think what we're seeing in private credit right now is the pricing in that there will be default risk. Not necessarily that there's no default risk. There hasn't been any default risk for the last several years. So that's a bit of a readjustment of some of the way of thinking about the sector. But then you have a lot of investment in data centers, and then these bottlenecks and slowing things down, that sort of interrupts the flow of cash because you can't get what you need. You have to pay up for it. And I think that's the kind of thing that slows down the march of artificial intelligence, which in fact might not be a bad thing because then they get to iron out some of the issues. They might even be able to get more efficient models if they have more constraints on the access to computing power. And I think with that, I'll leave you for today, and I wish all the best to all of you.